Hey guys, it's your big sister here. We're going on a hike today with my two dogs, Lucky and Whiskey. That's Lucky. Okay, Whiskey's behind us. We're going to talk about active versus passive investing. We're going to go over pros and cons of each, the tax implications of both, which is important, and then at the end, we'll do a nice summary for you. So get your shoes on. Okay, first up, active investing. Active, that means you are actively trading and buying. So this is when an individual or a professional, such as like a money manager, they're going to be picking stocks and bonds, other investments. They're trying to beat the market. So the goal here is to make more money than the overall market by buying and selling investments. And the thought here is that this is going to be based on research, predictions, strategies. That's the goal. Passive investing, you'll also hear people talk about this as index investing. So passive investing is when you're going to invest in a broad market index, such as the S&P 500 or the total stock market. So you're not trying to beat the market. You're simply trying to match its performance by holding those stocks for a long time. What are the pros of active investing? There's potential to beat the market. So if you have a money market manager or a hedge fund manager that's making good decisions, they might make more money than if you just invest in the whole market. There's flexibility because you're not buying a whole index fund that's tracking something. You can make investment decisions based on what's happening in the economy or the news. And there's some downside protection. So during a market crash, active investors are going to sell off their riskier investments to avoid bigger losses. Okay, so what are the cons of active investing? So active investing typically has higher fees. So you're going to be paying somebody to do all this management and spending time doing the research and coming up with these strategies. So this typically is going to cost you more in fees. Also, it is so hard to succeed consistently in this. Most active investors fail to beat the market in the long run. It is hard to always pick the best investments. The other thing is you're trying to time the market with this strategy, and that's difficult, and that often leads to mistakes. Okay, everybody had some snacks. Let's keep going. So, we're going to talk about passive investing now. What are the pros here? Well, the first one is lower costs. So there's no need for active managers to be doing research and coming up with strategies, picking investments, so your fees are going to be lower. It's also easier to understand. You're going to be investing in a fund that mimics a market index like the S&P 500. So you don't have to worry about individual stock performance. And also, we're looking at steady growth. Historically, passively investing in the market gives solid returns over the long term because the stock market tends to go up over time. Okay, so what about the cons of passive investing? So you have limited control. You're stuck with whatever is in that index. So you can't avoid stocks that might be losing money. There's no beating the market here. You're only going to get the same return as the market, which means you won't make more than what the overall market returns. And then there's some exposure to downturns. So if the market drops, your investments drop too because you're tied to that whole index. Okay, let's get into the tax implications. Here comes my old man, Whiskey. So, active investing. You are frequently buying and selling stocks. So that's going to lead to capital gains taxes each time an asset is sold for a profit. So you're not going to pay capital gains taxes on anything you sell for a loss, but anything you sell for a profit, you're going to be paying capital gains taxes. And if you hold that for less than 12 months, those capital gains taxes are taxed at ordinary income. So short-term rate, which is tax at ordinary income, less than 12 months. If you hold it for more than 12 months, then you're going to be in the long-term rate, which is lower. Right now, that's 15%. Passive investing. So passive investing is going to be involving a lot less trading. So you're less likely to sell stocks often. So this means you're going to be paying fewer taxes in the short term, especially you're not going to be hitting up against that short-term rate because you're going to be holding this for more than a year, which is going to qualify you for that lower long-term capital gains tax. And that means you get to keep more of your money. Okay, let's end this walk with a little summary. So, active investing. It's going to feel like it's giving you more control, but it is more expensive with the fees and the taxes, and it is hard to beat the market. Passive investing, investing in index funds, it's cheaper, it's simpler, and it's going to provide you market level returns with fewer taxes over time, which means you get to keep more of your money. Isn't that what we want? Thanks for coming on a walk with us, guys. If you like hanging out with Lucky and Whiskey and want to understand finance more so that you can grow your wealth and build your dream life, hit that subscribe button down below. I'm your big sis. I got you. You got this. Oh my gosh, look at them.